The difference between investing and speculating. Graham defines an investor as someone who thoroughly analyzes a company, buys with a margin of safety, and expects adequate returns. In contrast, speculators chase trends, buy on hype, and often ignore fundamentals. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. He warns that most market participants behave like speculators, even if they don't admit it. Mr. Market, your emotional business partner. Graham introduces a famous allegory, Mr. Market. Imagine you're in business with a manic depressive partner who shows up daily offering to buy your steak or sell his at wildly fluctuating prices. Instead of reacting emotionally, the intelligent investor sees Mr. Market's irrational behavior as an opportunity, buying low when he's fearful and selling high when he's greedy. This is the foundation of value investing, making decisions based on logic and intrinsic value, not emotions or market noise. Margin of safety. The central concept in Graham's philosophy is the margin of safety, buying an asset below its intrinsic value to allow room for error. If a stock's intrinsic value is $100 and you buy it at $70, you have a margin of safety in case something goes wrong. This buffer protects investors from unforeseen risks and market volatility. The essence of investment management is the management of risks, not the management of returns. Types of investors: defensive versus enterprising. Defensive investor seeks safety, simplicity, and long-term stability. Avoids individual stock picking. Focuses on diversification through high-quality bonds and index funds. Emphasizes low maintenance and consistency. Enterprising investor, willing to devote time and energy to research, looks for undervalued stocks, special situations, or market inefficiencies, accepts higher volatility for potentially higher returns. Graham stresses that both strategies are valid, but you must know yourself, your temperament, skill, and willingness to do the work. The importance of investor psychology. Emotions are a bigger threat than market movements. Fear and greed lead investors to buy high and sell low. Graham insists that discipline, rationality, and emotional control are more important than intelligence. The investor's chief problem, and even his worst enemy, is likely to be himself. By staying grounded and sticking to a long-term plan, investors can avoid costly behavioral mistakes. Stock selection for the defensive investor. For the defensive investor, Graham recommends a simple, rules-based approach. Diversify, hold 10 to 30 high-quality stocks. Favor large established companies with consistent dividends. Avoid hype and hot stocks. Look for low price-to-earnings (PE) and price-to-book (PB) ratios. Rebalance periodically. This is a strategy that seeks adequate, not extraordinary returns with minimum risk and effort. Stock selection for the enterprising investor. The enterprising investor is more hands-on. Graham outlines several opportunities: undervalued stocks, below book value or low PE, special situations, mergers, restructurings, spin-offs, bargain issues, stocks priced irrationally low, contrarian plays, buying when others are fearful. This strategy requires research, patience, and the ability to go against the crowd. It's more rewarding, but also more demanding. The role of bonds and asset allocation. Graham recommends balancing stocks with high-grade bonds to reduce overall risk. A basic rule: keep between 25% and 75% of your portfolio in stocks, adjusting based on market conditions and your risk tolerance. A typical 50-50 stock-bond allocation offers both growth and stability. The goal isn't to chase the highest returns, but to preserve capital over time. Earnings, dividends, and valuation metrics. Earnings stability, at least 10 years of consistent profits. Dividend record, long-term, uninterrupted payments. Reasonable PE ratio, not higher than 15. Moderate PB ratio, no more than 1.5. These filters help you avoid overpriced or risky stocks. They're not perfect, but they offer a rational framework. Security analysis: intrinsic value matters. At the heart of Graham's philosophy is intrinsic value. What a stock is actually worth, based on its future earnings and assets. Price is what you pay. Value is what you get. The intelligent investor is always asking, is this stock trading below its true worth? Don't try to time the market. Graham strongly advises against trying to predict short-term market movements. The market is unpredictable in the short run, but rational in the long run. Instead, focus on long-term fundamentals, stay consistent, and ignore the noise. Final principles for the intelligent investor. Always invest with a margin of safety. Expect market volatility and use it to your advantage. Know your risk tolerance and temperament. Stick to a disciplined strategy. Avoid hype, trends, and hot tips. Think of stocks as pieces of a business, not lottery tickets. Graham's timeless advice. Don't try to time the market. Diversify, but wisely. Focus on value, not price. Think like a business owner, not a gambler.